morning, good afternoon, good evening, traders. This is Ed FX Trader again for part 2 of our series on divergence trading. So as I made mention before, you can watch part 1 of this video for a recap. But as I made mention before, is divergence is really a very good way of entering the market. Some professional traders, that's the only way they actually trade. And also, just so that you know, you can find divergence indicators all over on the internet, and many of them are actually quite free. So you can find those indicators that they will just spot the divergence for you, where you won't have to actually be looking for the divergence. And remember, divergence is where market and momentum, that's the oscillator, the indicator that you're using, are moving in opposite direction. So you'll have when price is making higher highs, whereby the indicator is making lower lows at that exact same point in time. And whenever you have that, you have divergence. Okay, and you will see that divergence really gives you very good entry points into the market, and you can always find them all over. Now, before us, I have the gold versus the euro. I'm going to be using this as an example. And I also have both the CCI indicator and the RSI indicator. Now, you can use just about any indicator for divergence. You have the CCI, you can use the RSI, you can use a MACD, you can use stochastic. So you can use many indicators, many oscillators in particular for looking for divergence. I don't necessarily have a preference. Of lately, I've just really been using the CCI. I think it's very good, but you can also use the RSI, okay? And wherever you spot divergence, you can look for entry. So right now, I'm at current market, and I actually want to show you a setup that occurred late last night into early this morning, whereby there was a divergence trade. Now, you won't capture every trade, every price movement, every move in the market. You're not going to capture everything. What you can try and do is to focus on a narrow set of currency pairs or indices or whatever it is that you want to trade, stocks, whatever. And you can decide that these are the currency pairs or the instruments that you're going to trade, so that you can remain focused on those. All right, so I know many persons don't trade the gold euro, and I don't trade it either. I was just looking at it because gold has been really moving, so I was just watching to see if the other gold crosses were also moving. So right here, the market is going up. We are in an uptrend, right? From here to here, we have been in an uptrend, and we have been in an uptrend from before. Okay, so we have been in this uptrend. Let me just put it on a higher time frame. The market has just been going up. Now, when you are in a trend and you want to get into the trend, you look for a hidden divergence. It's a continuation move. It's finding divergence to continue to move in the direction of the current market. Regular divergence, with regular divergence, you are looking for a reversal. So that's the main difference between hidden divergence and regular divergence, or classic divergence. So this was the setup. From right here to right here, you see that price made a higher high. But when you look on the oscillator, price did not make a higher high, did not move from a high to a higher high. Price moved from a high to a lower high, okay? And as I made mention before, once you are comparing highs, then you're looking to sell, you're thinking bearish. So this is a typical bearish divergence. This is a regular bearish divergence, okay, where price made a higher high. Notice that this high is higher than this high, but on the oscillator, right, this high is lower than this high. So whereby price made high to a higher high, on the oscillator price made a high to a lower high. This wasn't only on the CCI oscillator, but the RSI period 14, it was a similar thing. Price made a high to a lower high. So there was clear divergence, and this is a bearish divergence. Now, if you are looking to get in this upward move, that you said that market was moving up, you would then begin to look for a hidden bullish divergence. Okay, because oftentimes we see the market moving and we want to get in, and generally for me, whenever I say price is moving or price has been moving up, I don't just jump in the market. I wait for a pullback, a retracement, and then I look for an entry to get in the move. So I still want to look to enter low. So one of the ways that we could have done this is that we already realized that market has already been going up, okay? This market has been in an uptrend. So even at this most recent move here, we could look, here was a pullback, right? So you saw the bearish divergence that caused the market to pull back. You had this short-term reversal that caused the market to pull back. With this pullback though, it provided a hidden bullish divergence for us to also get in buying. So if you compare here, you had a low to a higher low, but on the oscillator, you had a low to a lower low, right? On both oscillators, both the RSI and the CCI, okay? So here you have, let me make sure that this is higher. Let me see. This low is 1594.68. This low is, okay, let me see this. This is, oh no, this is actually lower. Oh no, so this one won't count. I actually thought that this was higher than this. But when I'm comparing it, this low is 59.5 and this low is 59.4. So actually it actually isn't a divergence. So we actually will delete that. Sometimes you really have to compare the prices because it was so very close, but it was actually lower. So this wasn't a hidden bullish divergence. No problem there. So we had this bearish divergence, okay? So this was one way to enter in and sell. On silver, if anybody has been watching silver, silver has just been going up, right? So if we look at silver and we wanted to get into this move, let's look at silver. Silver has just been going up and up and up. So if we were looking for an entry, let's say to get into this upward move on silver, right? We still want to try and enter at a low price. So we would look for a bullish, a hidden bullish divergence, all right? I don't want us to be really caught up with the names. Essentially, you'd want to look for divergence to get into the upward move, right? Or divergence to look for a reversal. So if we wanted to find out how we could participate in this move, even up to last week, we had price went from a low to a higher low, and we had price went from a low to a lower low. So this would have been a bullish divergence. Remember, once you're comparing lows, you're automatically thinking bullish, right? Because just think that when you buy the market, right, which means that you want to be bullish, you want to buy low. So once you're comparing lows, you're automatically thinking bullish, okay? And once you're comparing highs, you're thinking bearish. So this was a low to a higher low, whereby on the oscillator, on both oscillators, we were going from a low to a lower low, right? Not only did it provide us this bullish, but this was the one that provided both. It went from a high to a higher high, but on the oscillator, it went from a high to a lower high, right? Both oscillators. So we had a bearish divergence in which we could have sold right here, and then we had a bullish divergence in which we could buy. So after the sell opportunity, there was a buy opportunity to continue in this upward movement. Okay, so that's essentially how you use divergence. And all you will do to enter is that once you see, I mean, the exact confirmation will be after you have a fractal low. So this was a fractal low, which will be confirmed after this candle is closed. But once you begin to spot the divergence, then because it is such a good entry, the reversal almost in many cases happen. So you could have already begin to enter into this market once you saw this being formed here, right? That this low was higher than this low, and then it saw the disagreement on the oscillator. Once you begin to spot that, then you just can begin to enter with proper risk management, of course, in the event that it doesn't work out. All right. So this is how you can enter the market on divergence. It is a strategy, of course, that you can use in and of itself, because it is really, really that good. Here we are again, where we have a low to a higher low, and we have a low to a lower low, right? This was divergence again to get into the trade. So once you begin to look on it, and if you look here, the market turned, right? So let's bring in right here. The market turned, and that was all she wrote. You just had upward movement from there. So you're getting in right at the turning point. That is the brilliance of divergence. You're actually getting in right at the turning point. Here it is again. You had a low. You have a low here to a lower low, okay, in this instance, and you have a low to a higher low. Once you have the divergence, get into the market, right? And then you just enter buying, and you're getting in right at the turning point. And if you can see here, you have a wick to the downside, right? So this was extra confirmation that the bulls are taking over, and they just begin to push price up. So as I continue this series, I've done stochastic trading, and this will complete divergence trading. There's really nothing much to it. I just identify one of the strategies that I am posting in the Simple Forex Strategies series that I'm doing. Just identify one strategy that you're comfortable with, and just stick to that strategy and just make money. Okay, so this is Ed FX Trader signing out. Happy trading.